Been a rough ride for the markets through this year, rising fears about a possible recession. But our featured guest today says despite the negativity, he doesn't think we're going to head into a 2008-style market turmoil situation. Joining us now for more, Peter Hodson, founder and head of research at 5i Research. Peter, great to have you here.
Thank you very much. It's great to be here.
All right, so every time we hit these times of trouble and turbulence, we start to think about the times before that were tough for us as investors. You say don't look to 2008 as some sort of example of what we might be in right now.
No, I think if we have a recession, it'll be a normal type of recession, which typically means it's shallow and short. The average recession is about 11 months these days. Everyone's concerned about 08, and if you sort of were sleeping for 20 years and you came out and you looked at the stock market today, you'd say, oh my gosh, we are in so much trouble because the stock market's so horrible. But in 08, I couldn't wake up in the morning without a bank going out of business, or an auto manufacturer going out of business, or a house collapse and credits collapsing everywhere. Credit seized up, earnings were horrible, and the US was losing 400,000 jobs a month. And so now we've got a situation, the worst thing that happens right now is your company, instead of growing at 20%, is growing at 10% or 15%. And investors are going, that's horrible, sell everything. You've got 200,000 jobs being created each month instead of losing jobs. And so it's just one of those situations where you had this selling that fed upon itself, you had this fear of interest rate hikes, you had fear of inflation. But if you look at almost every cycle in the past, higher interest rates are not that bad for the market. And the reason for that is higher interest rates come with a strong economy. So here we are, strong economy, higher interest rates. It's economics 101. It really is. But for some reason this year, people have gone in full panic mode and the world's ending and it's not going to end. I just don't know when this pain's going to end. Last week was great, but 2 days doesn't make a trend. But I think what will happen is people will start relaxing and they'll start focusing on earnings again instead of everything else. It's been a tough year for managers because corporate earnings don't matter. It's all about the Fed and what the macro picture does. But we'll get back to basics one of these days.
Getting back to basics, then, that would lead me to believe that we have been spoiled as investors, spoiled as consumers, really, for a long time because the cost of funds, the cost of borrowing was so very low. But you get back to a point, could we get back to a point where you're just sort of like, well, this is sort of what it costs to borrow money. This is normal, and an economy can handle that kind of cost of borrowing.
It really can, and this is where the jobs picture is really quite important. I mean, there's 10 million jobs available right now in North America. So in 08, people were losing their jobs and they were underwater in their houses, and they would just hand the key back to the bank. And then the bank would have excess supply and house prices would collapse. So if you've got a job right now, you're going to keep paying your mortgage. Yes, you are going to have $1,000 less per month if you're on a variable rate mortgage. But it costs money to borrow money, and we did have it easy, and that's why we had a huge ramp up. Now we're just getting back to normal. A lot of companies that were trading at 50 to 60 times sales, they're not going to be around. If companies have negative cash flow, watch out for those. But you've got companies with lots of cash and lots of cash flow at cheap valuations. And you really just have to buy stocks that are going to be here in 2 years, because I think it's going to be changed in 2 years. We'll be back to normal. And maybe we'll have a bull market one of these days. No one expects that, but you know what? This is not going to last forever. Just make sure your stocks are here when the party starts.
It speaks to, I think, of not only removing emotion to a certain degree, and this has been a very emotional year. Yeah. It's been an emotional couple of years given everything that's going on in the world, but also having a longer-term thesis. And if you have that longer-term thesis, you stand by it. Because if day to day, and I fall prey to this too, I get a little emotional about what's happening, and you realize you got to step back and say, wait a minute, why did I do these things in the first place, and what's the end goal?
Absolutely, and the thing that sort of helps us out a little bit is each day, if you own a profitable company, then your company has more money today than it had yesterday. And most companies are operating 24/7, so even on the weekends, you've got 3 days more money today than you had on Friday. And if the stock's going down, then your risk-return ratio just keeps getting better and better because you got a cheaper stock price and you've got more cash. Eventually, people will realize that the world's okay for most companies. Sure, as always, some companies are going to be in trouble, but as always, some companies are just going to knock it out of the park, and that's what we're looking for.
Now, in the short and the medium term, obviously, we can still have, as you said, probably a lot more volatility ahead. Even the fact that I was talking about, well, over the weekend we heard from Mr. Waller, and he had this to say about Fed policy, then Vice Chair Brainerd coming out today, and we're still in a reading the tea leaves kind of thing. That seems to be a situation as we try to read those tea leaves and wait for every inflation report and every jobs report that we can see some wild swings still in our future.
Absolutely. I mean, we're not quite completely clear sailing right now, but if I can go back maybe over the past decade when I was a portfolio manager, I can't remember looking at inflation for 15 years. I didn't care. Nobody cared. They cared about jobs and corporate profits. So now we've got a new, something new to worry about. But as that sort of settles in, like unless, a lot of people are saying, oh, we're going to get into a Venezuela type of 1,000,000% inflation scenario. If you buy into that, then you shouldn't own anything, of course. But I think you'll get back to a normal situation. Maybe you don't get 9% inflation, maybe you get 6 or 5. Rates go up, the economy slows down, and everybody adjusts to that. So certainly there's volatile days ahead, but historically, you have to be there on the good days. You have to be on those, last Thursday, you have to be there to get long-term performance. If you miss the best 20 days of the market over 10 years, you almost lose money. You have to be there on those great days.
Now, we have an engaged audience listening to our conversation. Actually, someone sending in a question. I'm not going to wait for the question period because I think it's sort of germane to what we're speaking about here. We have a viewer basically saying, okay, you're talking about a strong economy, but they feel like we have unnatural inflation. A global pandemic sort of changed the rules. Are the normal rules gone given what we've lived through since the spring of 2020?
Well, there's a lot of talk about how globalization is going to fade away because of what happened with the supply chains. And that may cause some additional inflationary pressure as everybody brings things in-house. Absolutely, there was a labor shortage when everybody's sick. You've got production, you've got semiconductors closing factories. So absolutely, there was a short-term impact. And the question is, as the world gets back to normal, how does that change? And this is where maybe the Fed and central banks are not doing it properly. Like they're trying to stop demand, whereas in reality, you need to improve supply. Again, basic economics 101. As long as you've got a supply issue, you're going to have pressure on prices. But again, greed is a great solution because companies will realize this, they'll ramp up domestic capacity and prices will go down as that ramps up because they don't want to have the issue with globalization causing problems like it did in the pandemic and with the war. So there's going to be a lot of changes, but it doesn't necessarily mean things are going to be bad. As a company increases production to meet demand, they'll do pretty well, and then prices will naturally level off.
If a mild recession, which seems to be what everyone is baking into their forecast for the most part, becomes a deep recession, how much longer could it be before we play out this thesis of getting the world back to normal, getting the economy back to normal? Yeah,
I think it's one of those situations where the deeper the recession is, the faster it'll change. The deeper the recession, you'll have a deflationary problem instead of an inflationary problem. But certainly from a stock market point of view, I think investors right now are expecting not that bad of a recession. Like it's hard to say because the market's been so bad in certain areas, but I think the common theme is inflation will get under control eventually, rates will peak eventually, corporate profits will dip, but not that much. And so that's the big variable. So right now, most analysts are expecting profits to rise next year, year over year. That could change, and that could be maybe a year of stock market volatility. But as you know, the market looks forward. So maybe if it's a year, they sort of say, okay, it's time to buy in 6 months. So we might have 6 months more of pain, maybe 9 months if things get really bad. But again, if you're a long-term investor, which you should be, 9 months is nothing. It really isn't. You should be 5 years, 10 years, and this will all be a little blip that we talk about down the road. And I'm really convinced that in 5 years, a lot of investors will say, wow, look at how cheap that stock was. And they'll say, why didn't I buy more of that at that time? But it's hard. It's hard to fight that emotion, and it's hard to fight the trend, and the negative momentum keeps feeding upon itself. So we have to get through that.